Okay, so we're going to go ahead and call Senate Committee on Revenue to order. Madam Secretary, please call the roll.
Senator Buck. Here. Senator Doñate. Senator Severs-Gansert. Senator Spearman. Here. Chair Neal.
Here. So mark Senator Doñate present as he arrives. So we have two bill presentations today. We are going to hear Senate Bill 233 first, and then the second bill after that. So we will call the presenters to the table. I want to make sure that when you present the bill outside of your presentation, that you present from the proposed conceptual amendment first. And then if there's any change to the written bill that are intact, that you tell us that as you move through the amendment. Okay, so come on to the table.
Good afternoon, Madam Chair and members of the committee. For the record, I am Nicole Cannizzaro. I represent Senate District 6 in the Las Vegas Valley, and it is my pleasure to bring to you today Senate Bill 233, which seeks to revise our tax structure governing the rental of heavy equipment. Before going over the bill, I would like to provide a little context and explain why I believe this is a good piece of legislation. As the law currently stands, Nevada assesses a full year of tangible personal property tax on any piece of heavy equipment that is in the state on July 1st of a given year, even if that piece of equipment is only in the state for 1 day. Nevada is one of only 6 states that continue to use this form of taxation on heavy equipment. The other 44 states have all moved to various forms of taxation or fees that are less onerous on business, and in doing so have become more attractive places to do business in this space. In Nevada, we, of course, as this committee knows, pride ourselves on being business friendly. And as such, we continually search for the best ways to balance the need for revenue with maintaining a competitive edge over our neighboring states. I believe Senate Bill 233 corrects an imbalance that places an unfair burden on an important business sector for our state. And it does so while ensuring that we will continue to earn revenue from this sector in the form of a gross receipts tax. There is, as Madam Chair mentioned, an amendment that is available for the committee members on Nellis. And at this point, Madam Chair, with your permission, I would like to turn the discussion over to Bryden Gordon from Applied Analysis, to take the committee through the bill as we propose it to be amended.
Great. Thank you, Majority Leader. Brian Gordon with Applied Analysis for the record. I have about 8 or 9 slides here to walk you through in terms of providing a little bit more detail as to what you just heard here in terms of the issue, and then I'll be happy to walk you through the proposed amendment language for your consideration.
Thank you for that.
On the screen for you today, I've got a couple of high points in terms of just summarizing what the issue is. I think you've just heard the summary of what the challenge has been for heavy equipment rental companies. The reality is that this equipment tends to move not only within the state between counties, but it also moves between states inside and outside of the state of Nevada. And this type of equipment currently is assessed and taxed based on where it sits on July 1 of every year. And so that's created some challenges for heavy equipment rental companies. One potential solution here that has been identified is taking a look at ways to potentially alter that structure, which would allow for the taxation of that equipment to essentially follow the economic activity of that particular equipment. And so what we've included here for you are a couple of concepts surrounding that, really looking at replacing that personal property tax measure or approach that currently exists on that specific type of equipment and replacing that with essentially an excise tax. The idea being that we look backward as to what personal property tax has been generated off of that equipment historically and develop an alternative structure that is designed to keep that revenue on par with where it's been historically. As you heard, only 6 states currently are taxing this type of equipment under personal property tax regime. Others either don't tax it at all or they've made some other alterations, and I'll walk you through some of those details as well. One thing that we thought was important to present was the types of companies that may be impacted by this proposed legislation. On the screen, I've got really 3 different types of companies that are most likely to have an interest in this particular legislation. One being the equipment owners and operators. So imagine a mining company or a contractor that owns their equipment and they use that equipment and operate it internally for their purposes. That would not impact these types of organizations. You also have dealers and companies that sell heavy equipment exclusively. Those that are in the business of selling equipment would also not be impacted by this proposed legislation. And then the equipment rental companies, those that are essentially renting the equipment to the public at large, are the ones that would be affected by this, as well as those that would be the renters of that equipment. So specifically, these would be businesses that fall under the North American Industrial Classification System, NAICS codes, if you will, 532412 and 532310, essentially companies that rent heavy equipment to the public. The heavy equipment rental industry in the state of Nevada, the American Rental Association, does a survey annually of their members, and it represents about $900 million in terms of overall activity for these types of businesses, and they support all sorts of industries, including those included on the screen here: plumbing companies, painting companies. Obviously, the construction industry is critical, but manufacturers and others, you get the idea. They are a pretty wide-reaching organization and support a number of industries here in the state of Nevada. I mentioned this at the outset, but just to make sure we're all on the same page, as I mentioned, wherever this equipment sits on July 1st, the assessment date really determines its overall personal property tax under the current system. So if equipment is sitting in the state of Nevada in a particular tax district within a certain county, that property is assessed on that specific day. If it's not in the state of Nevada on that particular day, it does not get assessed and it does not incur any personal property tax. That liability is computed, and those companies are paying the personal property tax for the entirety of the year. I've got a couple of examples here that maybe just help provide a little bit of clarity as to why this can be a challenge or problematic, not only for the operators themselves, but potentially the state of Nevada and all the taxing entities within the state. One example I have here for you is if a piece of equipment was owned by a rental company and it was sitting here on July 1st, it gets assessed, and as I mentioned, they would pay the property tax for the entirety of the year. And then hypothetically, let's just imagine a couple of months later that property is transferred to the state of Utah because there happens to be more demand in Utah for that piece of equipment, and maybe the rental arrangement expired here in the state of Nevada. So that rental company moves that equipment into the state of Utah. In this example, I've got October 1st included in this particular example. In the state of Utah, they do that same assessment process, but on January 1st. So all that means is that a heavy equipment rental company that owns that property, they could effectively be paying the annual property tax twice in an overlapping period. So they're essentially being double taxed on that particular piece of equipment. And then we'll sort of take the inverse of that argument, I suppose, just to demonstrate what that potentially means for places like Nevada or Utah or others, where let's just imagine a piece of property, a piece of equipment was acquired on August 1st in a given year, so it missed the July 1 assessment date, and so it was a month later. They are not paying personal property tax really for the next 11 months in the state of Nevada because they've missed that assessment date. It came into the market because there was demand from a particular company to rent it, but it was after the July 1 assessment date, and so they're not paying the personal property tax in Nevada. And then just imagine they transferred it to Utah several months later on January 15th of the following year because there happened to be demand there. They also missed the January 1 assessment date in Utah. In this instance, a heavy equipment rental company would be paying zero tax in either state during that relevant time frame. So it sort of works in both directions, where for the operators it gets complicated where that property is sitting on any given day. Certainly I don't imagine that they necessarily would be moving equipment to avoid the July 1 date, but there's certainly a disincentive to have it just sitting here idle in Nevada at the same time. So this just gives you a sense of how it can sort of work against and for rental companies in both directions, and ultimately state and local governments from a revenue standpoint. The next slide I wanted to share with you, you heard the comments about the number of states that have implemented this type of alternative form of taxation. Currently, there are 6 states that are taxing heavy equipment rental property. You can see them here. We're sitting here in the state of Nevada today. Utah, New Mexico, Nebraska, Oklahoma, and Florida are the only other ones that are in a similar situation as we are here in the state of Nevada. And over the last decade plus, really 2 decades, 18 states have actually passed very similar reforms in some form or fashion to what's being proposed here. And you can see just from sort of reverse chronological order in terms of the states that have passed it, Michigan being the most recent one. Oklahoma is actively working on a similar initiative. But this gives you a sense of the various states across the country that have implemented similar measures to try to improve the equity as well as probably the transparency of taxation around this type of equipment. I think it's also worth noting, just talking with the folks at the American Rental Association, in all of these 18 states that have passed similar reforms, there have not been any initiatives to come back and reverse those reforms. They have not been challenged over the course of the past 20 plus years, so there hasn't really been any pushback as it relates to some of these alternatives that have moved forward in other states across the country. So I guess the end game of really where I wanted to close with is this notion that I guess maybe it's the better way to say it is the process that we went through. We conducted a proprietary survey of heavy equipment rental companies here in the state of Nevada. They sent us how much they're paying in their personal property tax bills. They also sent us how much rental revenue they have off of that same equipment. And so we obtained that data. We believe it's probably slightly more than half of all of the heavy equipment rental companies from a dollar amount perspective have submitted that data to us. And what we did is we essentially, over the last 3 years, we took the total amount of property taxes that they paid, we compared it to the total amount of the rental revenue that they generated, and compared the two, and we developed an effective tax rate of 2%. Is essentially the idea is to keep parity among where we have been, or at least keep those revenues on par with where we've been over the last 3 years from a personal property tax standpoint relative to the revenues that have been generated. And so that's how the 2% effective tax rate was ultimately generated, with the idea of keeping this the potential revenues on par with what it has historically been on a relative basis to the rental revenues and the personal property taxes. So those were essentially my prepared remarks as it relates to providing kind of the overarching review of what the bill is intended to do and some of the reasoning behind it. I don't know if this is a good point to pause and answer any questions or talk through the proposed conceptual amendment.
I think this will be a good time to talk through that amendment.
Okay, great. Thank you, Chair Neal. Submitted on the Nellis system is a proposed conceptual amendment. Really included here are a handful of adjustments or edits that have been recommended since the initial bill was drafted. One item that you probably see listed here is to provide further clarity around the types of companies that are subject to the heavy equipment rental excise tax. The goal here is to focus those measures on companies that are renting that equipment to the public. Avoiding any sort of layering of taxes among multiple entities, but also eliminating that tax across affiliates that may be renting to themselves. So this would be designed to essentially be passed on to the end consumer at the end of the day so that it's on a bill, everybody knows what that is and what they expect. At the moment, heavy equipment rental companies are absorbing the current property tax amount and building that into their revenue structure or their rental rates. This would just provide more transparency for the customer in terms of how much tax they're ultimately paying as it relates to this particular dollar amount. So that's what item 1 is intended to do. That affects sections 5, and 8, and 9 in the proposed amendment as it stands today. There's also an adjustment related to some of the exemptions. Currently, the bill exempts state and local governments that may be renting this type of equipment so that they're not being impacted by that. We did get some feedback related to exemptions for Indian tribes or nations. There just seems to be a lack of available data around being able to determine if that exemption applies or not. Again, this is just a preliminary draft in terms of an edit that may be appropriate there. If there's a way to address that more directly, certainly I think the proponents of this bill would be willing to discuss how to make those adjustments. Item 3, and that affected section 13.4, excuse me. Item 3 listed on the conceptual amendment is to modify the timing of how the funds are transferred between governmental agencies and streamline the overall accounting process. So this is sections 18.3, C, and D. The original bill was extremely complicated in terms of how the funds would be transferring between entities. We've had conversations with a number of groups, including the Nevada Department of Taxation, to better understand the mechanics of what may be a more streamlined process. So the goal here is to make these distributions back to the local governments on a quarterly basis. The heavy equipment rental companies would also be submitting the tax on a quarterly basis, so this would make it more timely in terms of getting those dollars back in the hands of state and local governments. But it would also streamline how the state were to deal with the revenues themselves. They would essentially take this in, they would take 0.75% of the revenues as a fee to cover administrative costs, and then distribute all of that funding back to the local government, distribute exactly how they distributed that funding when they were collecting it as a personal property tax. They would just be getting it from the state in the form of an excise tax, and they would just be required to distribute it along the same exact formulas. There's also a proposed amendment in section 18.4C. This would allow essentially the Department of Taxation to share with the local governments the tax districts in which this revenue originates from. So it would allow them to share that information back with the local governments. I don't think that would provide any issues from a confidentiality standpoint, but it would require that authorization so that they could have the information in terms of where that tax originated, so they know how to distribute it. And then the last one was really to establish a revenue allocation methodology to ensure existing tax beneficiaries remain whole on a relative basis as of the date of the legislation. And so, as you can imagine, personal property taxes get distributed to a number of different taxing entities, state government, local governments, as well as special districts like the school district. The idea here is that this would allow the local governments to distribute it in those same formulaic or distribution amounts on a relative basis. So those were the primary amendments to the proposed legislation. I'm certainly happy to answer any questions.
Thank you for that. Members, any questions? Okay, so I have questions. So on the proposed amendment, you're listing in number 4 to allocate the balance of the revenue by a replacement tax. And the first thing that popped up in my mind, and I don't know if you looked at this, is whether or not this violates streamlined sales tax agreement, SUTA. Whether or not a replacement tax, because technically now you're creating an excise tax, and then you're literally calling it a replacement tax. Whether or not SUTA is somehow being impinged with that language.
Brian Gordon for the record, Chair Neal. That's a great question. I don't know the specifics of what the appropriate response is there, but this is obviously outside of the sales tax. We're talking about a replacement for the personal property tax, but we can certainly dig in to see if there's some impact related to the streamlined sales tax.
Okay. And then my second question, and you kind of touched on it a little bit, where you're saying it eliminated the exemption on the tax to tribes, but when I read the language in the bill, the thing that popped up was the elimination of the exemption is now creating the ability for them to be taxed. That's how I read it.
Chair Neal, Brian Gordon for the record. I'm reading it the same way.
Okay, all
I think
right.
there was a challenge in determining who qualifies under that exemption, and so there was a suggestion that exemption be eliminated, but I'm assuming the proponents would be open to alternatives if there's another way to determine that with certainty.
Okay, because I was trying to read and understand, what other states have done, and typically tribes have been, I guess, excluded depending on whether or not there is a treaty in place, whether or not there's some other legal priority that's been in place where we cannot just decide, because this is personal property tax, right? And so there have been clear rules around property tax in general on tribal lands, but I guess, what did you look at to do your research to determine whether or not this strikeout was appropriate? And maybe that's what I can read as well.
Fair enough. And Brian Gordon for the record. Candidly, we received some feedback from folks at the state that suggested it may be difficult to determine whether they could qualify for this particular exemption. That's why I say if there's some alternative that would allow that determination to be made, I don't know that it necessarily needs to be stricken from the list of exemptions, but that was some of the feedback that we received. So happy to close the loop on that one with you if that's helpful.
Yeah, because you have all the other government entities or United States, and they are their own government. I think there's a nuance here that may be missed. So we'll both research and find out what that answer is. The next question that I had was on number 3 in the proposed amendment. You had modify the timing and how the funds are transferred between the governmental agencies. And it wasn't clear on exactly, what is the timing delay that we're talking about? And the second question that I had tied to that was that typically, personal property tax is distributed down. And so what does the time delay mean, and what is the effect on the local governments if it had, my understanding, does have some C-tax crossover? So what's the effect of the delay because there's a payment or drop down that happens?
Sure. Brian Gordon for the record. The idea behind the amendment was to have the timing of the payments essentially track with the distributions to the local governments. So the tax is due quarterly. So let's just imagine it's on a quarter end. June 30th is the first quarter of the tax that's due. The taxpayer would be required to pass that tax along by the end of July. And then the way it's currently drafted, the state would have up to 3 months to process those collections and the reporting of that and remit that back down to the local level, so the first month of the following quarter. And then they would have the ability to distribute that to all of the various taxing entities that would have participated in the personal property tax structure.
Thank you for that. I mean, I have another set of questions, but while we're on this distribution model, I believe it's section 18, where we're talking about the transference, where you're talking about on the last day of the month of each calendar quarter, and then you create this transfer to the intergovernmental fund. I guess it just seems to be a lot of workaround just to get to the end result, I just want a little bit more conversation on that distribution pattern. What did you hear? I know you've been talking to Department of Taxation, but in terms of like, is this creating an additional burden than the pathway that you're creating here?
I don't know whether that's an additional burden or not for any of the taxing entities. I suppose from the state standpoint, there's a little bit of an additional level of effort that's required. Typically, under the personal property tax regime, the county treasurer would essentially be billing that amount and collecting those dollars, is my understanding, and then they would be allocating it out to the various taxing entities. Under the proposed regime in Senate Bill 233, the funds would be remitted to the state, much like the fashion that the sales tax is. It would go to the state, they would put that into a bank account, they would take their 0.75% of the revenue off the top for administrative fees and simply send that back to the counties with reporting that would demonstrate which taxing districts the revenue originated from. And then the counties would just distribute it along the same exact formula that they were doing the personal property tax. It's just coming back to them from the state as opposed to them collecting every single property tax bill themselves. The state would be doing that effort on their behalf.
Okay. So I'm probably going to come back to that, but I have a question on section 6. So you remove the affiliate. Who is the affiliate? Who is represented by the removal of that language?
Brian Gordon, for the record. Fair question, Chair Neal. My understanding is that there are some companies that essentially lease or rent the equipment to themselves. They hold the equipment in one entity, maybe for tax purposes, federal tax purposes. They rent it to an affiliated entity for another reason, probably for federal tax purposes or some other reason. But they're under common ownership, and so they're not actually renting the equipment to the public. They're just renting it internally between affiliated entities. So the idea was to avoid a rental charge on companies that are renting to themselves. That was the concept behind it, and focusing the rental charge or the excise tax on rentals that are essentially to the public at large.
Okay. And then on the section 7 on the end date, the open-ended end date where you have a rental contract with no specified end date, basically that sounded like ownership. But who are you really going after with that language? You have the not to exceed 365 days or an open-ended contract with no specified end date.
Brian Gordon, for the record, yes. The idea here is just that we're talking about folks that are renting equipment for a specified term, and if it's just not open-ended, and so that's the idea there, to focus on specific rental terms and tax those agreements.
And so the generic question here was, you're passing it to the consumer, I get that. But with the open-ended end date, I guess the category of the type of contracts that end up being that way, how the distribution of the tax that's paid, because I guess you're capturing it at the beginning of the rental, and so then there's a distribution, or is it at the end when they return it?
My understanding is it would be when that equipment is rented, which my understanding of that would be it's when it is invoiced and paid for, is essentially when that tax would get applied. So if you had a 9-month lease and you were paying the rent on a backhoe on a monthly basis, my impression is that you would be collecting that 2% tax on the monthly invoices and payments that would be made, not 9 months worth of rental revenue all up front.
Okay, and then my final question, and it's really generic, because after I read this bill, my first thought was, why don't the heavy equipment folks just pay it? Passing it on and then creating this complicated structure, I believe complicated structure, to pass it on to the consumer, why not just pay the tax and just move on?
Brian Gordon, for the record. I think that was a question, so I'll try to answer it. I appreciate it very much. The challenge, I think, for the operator, the rental companies today is they're getting this one-time assessment for personal property taxes, they have no idea how long that equipment is going to be in the state of Nevada or in a particular county. The equipment is very mobile. It moves depending on where the demand is for that equipment. Sometimes it's between counties, sometimes it's between states. So if their objective is to recoup that cost of doing business from their customers at the end of the day, and they only know if they're going to be renting it for, they don't know if they're going to rent it for 2 months or 12 months. I mean, they could front load the entire annual personal property tax in the first 2 months of an agreement with a customer to ensure that they recoup the entire year's worth of personal property tax. In that instance, they're probably, quote, overcharging that particular customer relative to their actual cost of providing the equipment. So making it more transparent, it's on the bill. The economic activity is essentially what's being taxed. The time that it's being rented is when that charge is being incurred. Just makes it, I think, more transparent for the customer, and it makes it operationally more manageable for the rental companies to know how to allocate that cost among their customers.
Okay. Thank you for that. So Senator Spearman has a question, and then after that, we'll move to support.
Thank you. I am not as adept as my esteemed colleague, Madam Chair. So my question is probably kind of pedestrian. But in Section 7, and it prompted me to ask a question, you said that sometimes they rent to themselves. It's one entity. One person owns this entity, A, and A could rent to B. And so in Section 7, it says entering into agreement with a heavy equipment company for the use. So does that take into consideration that it's the same person or the same company?
Thank you, Senator Spearman. Brian Gordon for the record. The idea is that if it is an affiliated company where there is common ownership, that the tax does not apply because they would essentially be taxing themselves, and it's not really an arm's length transaction. It's not being rented to the public in an arm's length way, and so to avoid that internal taxation on themselves, this is, as currently drafted, is designed to exempt the tax on affiliated entities. Does that answer your question? Thank you.
All right, so we will open up for support for SB 233.
Good afternoon, Madam Chair. Good to see you. For the record, Trey Abney with Abney Talcon Group here today representing 2,000 small business members of NFIB in Nevada. We are in support of SB 233. We believe that the antiquated taxation structure for heavy equipment rentals needs to be updated. As you heard, we're one of the few remaining states who have not modernized our processes, and we've heard about this issue for years from these equipment rental and leasing companies. As I'm sure you know, on July 1 of each year, each piece of equipment, if it's in Nevada, is assessed a full year of property tax in addition to the sales tax paid by the end user, and this piece of equipment may leave Nevada's borders the following day and not return for the year. There is no pro rata allowance, so why would any company choose to keep their equipment here? Existing law puts our state at a competitive disadvantage and is a disincentive to keep and maintain necessary equipment in the state. We believe this equipment creates jobs, opportunities, and helps construction projects stay on schedule. We do not support new taxes in this case. This is an industry-supported tax that allows for more predictability for the end user, the industry, and the consumer. Both the American Legislative Exchange Council, or ALEC, and the National Conference of State Legislatures, NCSL, have suggested fixes like these being proposed in this bill. So we support these efforts toward fixing this broken system and preserving Nevada's economic vitality. We thank the Senate Majority Leader for bringing this bill. Thank you, Madam Chair.
Thank you for your testimony. Next.
Thank you, Madam Chair, members of the committee. My name is Mac Bybee. I represent the Associated Builders and Contractors of Nevada. Not to belabor the point, we believe that this modernizes and creates a more efficient tax structure. But to talk about, it was a point that was brought up by Senator Spearman and you also, Madam Chair, on the affiliated exemption. So a lot of construction companies that run in heavy equipment will set up a business where they'll purchase their own equipment, and then they'll use that model to lease to the actual construction company. So that would be the common ownership. Now, I'm sure that there's efficiencies and things that are built into place, and I'm not being a contractor, I'm not sure what that advantage is, but that was created so those construction companies who aren't already, they're not captured under this tax structure already, wouldn't be brought in under the new bill or the new structure should this legislation pass. So, thank you.
Thank you for that information. Next.
Thank you, Madam Chair, members of the committee. My name, for the record, is Terry Graves. I'm here today sitting in for Paul Enos, representing Nevada Trucking Association, Nevada Manufacturers Association, and basically we want to do a Me Too for supporting SB 233 and appreciate Senator Canazaro's efforts to bring this forward. Thank you.
Thank you for that. Is there anyone in Vegas in support of SB 233? Is there anyone on the phone lines, BPS, in support?
Chair, there are no callers in support at this time.
Okay, so then we will go ahead and open up for opposition to SB 233. Come in and fill in all three chairs.
Thank you, Chair Neal, members of the Senate Committee on Revenue and Economic Development. My name is Vincent Guthreau. Last name is spelled Gutreau. First name Vincent, Vinson. I serve as the Executive Director of the Nevada Association of Counties, or NACO. Our membership is all 17 of Nevada's counties. I am testifying in opposition to Senate Bill 233, which affects personal property taxes assessed on heavy equipment. Similar bills to SB 233 have been introduced in prior sessions. And while this bill language is different, we actually think it creates a more complicated system and impacts local revenues in similar ways. And the policy changes will impact local government service delivery in a variety of ways. For this reason, our opposition to this proposal remains. And as mentioned, NACO has testified in opposition in past legislative sessions on similar proposals. It doesn't look like a lot of the fiscal notes made it up on Nellis yet, but you will see that eventually. While this is not a muddy committee, I do think it's worth highlighting some of the services that this tax pays for, services that are critical to our shared constituency. For instance, and you'll hear directly from Clark County on this, but it funds E911 services, public safety, and services to our most vulnerable populations. In Washoe County, this current revenue source funds similar services, public safety, indigent care, some of our library services. It funds family service courts, and also funds services to our homeless and unsheltered individuals. Under this proposal, a new gross receipts tax would be introduced on the rental of heavy equipment and then submitted to the Department of Taxation. And then after an administrative fee, which directly impacts local government revenues, the funds would then be dispersed back down to local governments. You'll hear from county assessors on the viability of that distribution, along with the details on how this doesn't meet their criteria for fair and equitable taxation. I will point out that the administration of this distribution is a little bit problematic for local governments. I know it was discussed, I think in Clark County, again, they can speak directly. There's about 140 taxing districts that represent this are distributed this revenue. There's no mechanism to show how the trickle-down tax revenues are assessed and how we believe it's just a problematic implementation under this new proposal. I will admit that I haven't had an opportunity to review the amendment. I think it was recently put on there, but I think our opposition remains to the bill as written. Again, I defer to the assessors. There are concerns around tax avoidance situations, which we think further complicates the fiscal impacts. And again, you'll hear further information from those county assessors. And we support their testimony and encourage its consideration by this committee. Thank you for the opportunity, Madam Chair.
Thank you for that. So just for the record, the fiscal notes will be posted tonight.
Great, thank you very much.
Go ahead.
Thank you, Madam Chair. Joanna Jacob on behalf of Clark County. I was going to note for the record that we had just filed the fiscal notes on March 20th, so thank you for that note. I'll concur in the comments from NACO. We have had some conversations with the bill proponents as early as September on this proposal. We reiterated our concerns with the structure that now you see in the bill. We've also asked, and the reason for our opposition from the Clark County, though I will note that my Clark County assessor is also going to testify in Vegas. So from Clark County itself, the reason why we are concerned about the details of this proposal and really trying to figure out on whether it is actually revenue neutral to counties is because of the things that it funds. It funds not only school debt, but state education, our indigent accident fund in Clark County and in counties that helps to compensate hospitals for unpaid claims. We can fund it funds cities, libraries, Metro 911, medical assistance to indigent care, which is basically a key source of revenue for our hospitals and for the care to the indigent. Cooperative extension, our family court, and it really varies across our taxing districts that Mr. Guthrow mentioned. We have quite a complicated taxing district structure in Clark County, 112 of them. We collect it today. Collecting it at the state and giving the state an administrative offset and then sending it down to us, that is not an administrative offset for us, and then having to do this distribution. And I believe that Ms. Johnson, our assessor, can speak to that challenge. And I have asked for some evidence from the other states. I know this has passed in multiple other states. I've asked for some numbers on whether it has been, in fact, actually revenue neutral. We really want to make sure as this moves forward that it is because of the services that it funds. We're very open to the conversation, but that is our primary concern. So thank you very much.
Thank you for that. Go ahead.
Thank you, Madam Chair. Good afternoon, Senator Neal and committee members. My name is Andy Heiser. I'm the president of the Nevada Assessors Association, and I'm also the chair of our legislative committee. I'm here representing all assessors in our state, and you may also hear from individual assessors. I'm here to testify in opposition of Senate Bill 233. Article 10 of the Nevada Constitution establishes that legislator should provide by law for a uniform and equal rate of assessment and taxation, and shall prescribe such regulations as such a just valuation for taxation of all property, real, personal, and possessory. This bill has been presented in previous sessions, and we have been opposed for a couple different reasons. One, this does go against the Nevada Constitution for equal assessment and taxation. Currently, there are no exemptions being given out through NRS 361 on property that is used for income methodology or for profit. Allowing this bill to exempt these types of equipment undermines the tax law foundation of NRS 361, which guides our offices. The agency which handles the collection and distribution will need to account for tax districts and entities, and this revenue would need to be distributed. And implementing this in the Department of Taxation seems to be outside of their normal boundaries. We have accounts that are set up where this property is located with easy distribution into those tax entities. And then another major concern is large corporations who own these types of equipment. I know it was addressed as an amendment, but they still may create subsidiaries with other names and fall into this property tax assessment, which would have a fiscal impact on our counties. This does create an equitability issue between rental companies and construction companies who own these equipment, and this would not simplify our personal property tax system. We do have migratory property, NRS 361-505, that does allow for equipment to be partially billed if it does move in and out of counties or the state, and we also do that with airplanes. Thank you for your time.
Thank you for your testimony. Next.
Good afternoon, Madam Chair and members of the board. I'm Jana Seddon, Story County Assessor, Jana-Seddon for the record. I'm here to oppose SB 233 and in support of the testimony given by Andy Heiser, our President and Legislative Chair of the Nevada Assessors Association. I also have concerns for The small counties, as being a very small county with a lot of big things happening in our county, we already have difficulties with the rental equipment companies on their personal property declarations telling us that they have no equipment located in Story County because we have no situs locations for these equipment people right now. So we have a big concern that if these are reported, are they going to be reported from the location that they are leased out of, or are they going to be reported the location where the equipment actually is? Because if we miss that whole step and it goes to the state and it comes to us, it's going to be a very difficult time trying to figure out really where this equipment is. That would be a huge hit for our smaller counties. And like I said, we already have an issue this year. We had an equipment company that said they have no equipment in our county. They happened to fall up underneath our random audit through one of our audit companies. Lo and behold, there's hundreds of thousands of equipment that is located in Story County. I feel that if this process is changed and it goes through the state and somewhere else, we're going to have a very hard time figuring out where that equipment is really located, and it's going to be a huge hit for our smaller counties. Thank you for your time.
Thank you for that. So we will go down south for opposition.
Good afternoon, Madam Chair and members of the committee. Brianna Johnson, Clark County Assessor, in opposition of Senate Bill 233. And not to repeat what most everyone has said, but I do want to get my information on the record. And I'll start by saying that the mission of the Assessor's Office here in Clark County is to perform accurate and equitable assessment functions to serve the public. This is a core value shared by the assessors throughout the state. This is what we live by and a standard at which we are held to, and this is what taxpayers expect of us. What we have before us today, again, is a property tax exemption proposal similar to the one introduced in the 2019 and 2021 legislative session. We have not been provided with any evidence to show that it is revenue neutral, and even if this proves true, it doesn't solve the problem that identical items of heavy equipment would receive two different forms of tax treatment because it is either owned by a construction company or owned by an equipment rental company. This runs against the grain of uniformity of taxation. And this could, again, as mentioned before, open opportunities for business to seek a more preferred method of taxation by finding loopholes in this law. In addition, it states that the county treasurer will distribute the money collected to these taxing units. Currently, the Clark County treasurer, I'm not sure about other states, but I'm not sure, but in Clark County, the treasurer does not collect or bill taxes on personal property. The assessor's office bills and collects taxes on personal property, and we have no way, and I don't believe the treasurer's system, nor does the county assessor's system, have any way to take money and distribute funds back to those entities. The taxes are, the value and the taxes are composed or calculated through our taxing system to put those monies into those taxing districts. When the bill is paid, then that's when it is dispersed. We do not have any way to take revenue from another entity where those calculations have not been computed through our valuation system. So I just want to be clear about that. And also, we disperse monthly. There is a 30-day demand on personal property taxes. Some of our businesses are allowed to pay quarterly, but the majority of our businesses have a 30-day demand once they receive their tax bill. Also, again, we have concerns regarding the complexity of the bill and the additional burden it imposes on state and local government. If the goal is to introduce a new system of taxation that is truly revenue neutral, then why have a system this complicated? In addition, there are still many parts of this bill that are vague, subject to possible misinterpretation, leaving many unanswered questions. And for this reason, we are opposed to this potential legislation based on the inequity it creates between property owners and that it would be problematic to administer. The Nevada assessors believe the current method for assessing heavy equipment, rental or otherwise, is fair and equitable under the existing statutes. And I also want to mention that there was some discussion about the lien date. The lien date is the lien date. So any business that is in business as of the lien date, that holds true for all businesses in the state of Nevada. If you are in business as of July 1 and you go out of business in November of that same year, you are still subject to the tax. So to say that, yes, the equipment moved out, but that is the same rule, the same law applies to all businesses in this state. Thank you.
Thank you for your testimony. Next.
Thank you, Chairwoman Neal. My name is Mary Ann Widener. I'm the Clark County Deputy Assistant Director to the Assessor. And I'd just like to go through some of the sections of the bill that seem problematic. Some of them have been addressed in the amendment, but I'd like to just mention a few of them. Section 4(2)(c) talks about the definition of gross receipts. And as you go further down there, it talks about any discounts not reimbursed by a third party, which are allowed by a heavy equipment rental company and taken by the renter on a rental. The concern about this is this appears to give complete discretion to the heavy rental equipment companies to discount rentals as they see fit, including rentals to themselves or sister companies, which in essence could exempt the equipment from taxation if this was to be adopted. Section C, the section on, Section 6, the section on affiliate has been removed. However, the term still includes, and there's a definition there, and it actually mentions without limitation, machinery and equipment that is customarily used or designed for construction and industrial purposes, including without limitation. Then it goes on to actually identify some of the types of equipment. My question would be, what is the purpose of this section? It includes without limitation twice. This opens this up to interpretation and a myriad of possible rental equipment that the industry could classify as heavy equipment just on the basis of renting it through a heavy rental equipment company. And is it for construction or industrial purposes when in fact the heavy equipment may not be used for those purposes at all, or other equipment may not be used for those purposes? Using the terms including without limitation could legally refer to all kinds of assets that reasonably fall within the broad scope of this general statement. And I want to give some examples. Home Depot, for example, rents compressors. They typically rent smaller compressors. An example of one would be one that is 4.3 CFM. CFM stands for cubic feet per minute. That's how much air it moves at 90 PCI. United Rental also rents compressors. They have small compressors that are 3 to 4 CFMs. They also rent larger ones that are 1,600 to 1,800 CFMs. There are other, I noticed they took out lift, and I don't understand why they took out lift equipment and cranes, because cranes seem to me that they would be a heavy piece of equipment. But those were removed in the amendment. However, there's also material handling equipment, which is also mentioned. This could include anything from hand trucks, dollies, pallets, small carts, small pallet lifts, or to large lifts. If you were to look that up, you would see that. And the small rental companies have this kind of equipment. There's lots of businesses that have this kind of equipment that are having to pay property tax throughout our valley, which reinforces the issue with regards to equity. So this heavy rental equipment company can own this equipment, choose to use it for their own purposes, not have to pay any kind of property tax on it, or rent it and charge this separate type of property tax because it's classified this way, versus the rest of the state where businesses own these same types of equipment and yet they have to pay via the personal property structure. It just doesn't seem fair and equitable, which is what the Constitution requires us to do. In addition, I would like to mention Section 13. I know we were talking about exemptions, and I know you mentioned about the tribal exemption now being non-exempt. I would like to make it clear for the committee that currently no government entity or other exempt type entities are exempt from paying, when I say this, the exempt entity is exempt from paying taxes, but when an exempt entity rents a property from a not-for-profit organization, that not-for-profit organization pays taxes. So I'm going to try to restate that so that's clear. Current statute does not exempt any real or personal property for being taxed when it is rented or leased by an exempt entity. Current statute does exempt an exempt entity from paying taxes when they own the property. However, I'm going to give you some examples. So if a government entity is renting a building, we have that happen here in Clark County, and they're paying rent for that building, and they're paying the rent to the landlord. That landlord owns that real property. That landlord is responsible for paying taxes on that real property. The same thing with when it comes to personal property. Clark County, we work for Clark County. We have leasing equipment within Clark County. We have copy machines, and we have other types of equipment that we lease. They are leased to us by leasing companies. Those leasing companies have to pay personal property tax on those items in spite of the fact that we're renting them and we are a government entity. So I want to make that clear that what this is doing is it's literally exempting taxes on personal property that currently are not exempt. And then finally, just to discuss the complexity of the bill, it just seems that there's so much here in so many pages, over 9 pages of new language to revamp a system that isn't broken. It's working, it's covering the needs of our communities. You've already heard it testified that this could cause a problem with covering the needs of the communities. And I just want to say one last statement, that Ms. Johnson mentioned, our assessor mentioned about a business being opened after July 1st. They're not taxed for that first year. They would be taxed the following year. It's the same thing for a company. A company may be in business as of July 1st, and it's only the equipment that they own as of July 1st that gets taxed for that year. If they purchase any equipment additionally after that, if they purchase it in August, September, October, November, if it wasn't in existence on July 1st, they don't get taxed on that. They do get taxed on it on the following year. So there's nothing inequitable in the way that we're doing this for all companies. Heavy equipment is not being excluded from that. So that would conclude my testimony. Thank you.
Thank you for that. There's no one else down south. I don't see anyone. BPS, is there anyone on the phone in opposition to SB 233?
Chair, there are no callers willing to give testimony or opposition at this time.
Okay, thank you for that. Is there anyone here in neutral for SB 233?
Thank you, Madam Chair, members of the committee. My name is Alexis Motorex, representing the Nevada Chapter Associated Contractors, representing the commercial construction industry in Northern Nevada. The Nevada chapter is neutral on this bill as presented with the amendment. We've worked with the proponents of this bill and appreciate their efforts, as well as the majority leaders, to clarify in Section 5 that related or affiliated parties not primarily renting to the public at large are exempted from the bill. We look forward to continuing the conversation to make sure the language and intent are clear. Thank you.
Thank you for that. Okay, BPS, is there anyone in neutral on the phone?
Chair, there are no callers willing to testify neutral at this time.
Okay, thank you for that. So we will invite the bill sponsors back up for closing remarks, or do you have closing remarks?
Thank you, Madam Chair and members of the committee, for allowing us this time to present the bill. I know that Mr. Gordon does have, I think, some clarity on some of the things that were brought up. If the Madam Chair would like to hear some of those points, and otherwise, we just wanted to say thank you.
Okay, go ahead.
Thank you, Majority Leader. Brian Gordon for the record. Just a couple of quick closing thoughts, just purely from a factual standpoint that I heard. Yes, this is complex. It is not simple. I understand that. I appreciate all the feedback and the comments that we've had here today. I think it's been very helpful to have this conversation. Just a couple of quick items. I jotted a few notes as I heard some things that I just wanted to make sure were clear for the record and again, facts that I think may be helpful. This concept of affiliates, I know we've probably talked this one to death. The reality is if they are exempted, if these particular businesses are exempted from this affiliate concept, they are squarely within the existing personal property tax regime, so they would not be affected by any sort of exemption as it relates to the excise tax. I also heard a comment about Home Depot rentals and some of these other scenarios that seem to be in play as it relates to this legislation. The legislation does limit equipment rental companies to those with NAICS codes of 532412 or 532310. I do not believe that companies like Home Depots and others that are more retailers in nature that provide a wide range of goods that they sell, I do not believe they fall within that definition and would not be subject to the excise tax being contemplated by SB 233. And then as it relates to the classification of the property, these rental companies do classify their property differently than an owner-operator, a mining company, or a contractor. They actually classify these as inventory on their books as they look to rent them out and do other things with these assets. So there is a little bit of a difference in terms of how these assets, I believe, are treated for rental, heavy equipment rental companies. So again, just trying to make sure we have the facts for the record. I just wanted to point that out. And as the majority leader mentioned, we appreciate the opportunity very much just to share this information, and happy to provide additional clarity as we get additional information in. Thank you very much.
Thank you for that. All right, so we will go ahead and close the presentation on SB 233, and we will open up the hearing on SB 278. I don't know what the case is. So, Senator Spearman, before you present, do you have one amendment or two amendments?
Excuse me, there are two amendments, but the one that DHHS accepted is the one that I'll present, and we can work out the differences in terms of the language. I think both of the amendments are designed to facilitate childcare for those who are really in need and can't afford it, but we still have just a little bit of work to do. But I want to present it today so that you have that information, and we will come back at a later date.
So let me clarify, the amendment from Leah Case is not the amendment we should be reviewing?
It's portions of that amendment are what I'm presenting today.
Okay, because the one from HHS would have what name on it?
It's the friendly amendment that I'm going to use in our testimony. Let me simplify it, because it's two amendments, but they're saying basically the same thing with the exception of a couple of things in terms of children, the number of children in the home, and who actually determines eligibility.
Okay, because I'm just trying to figure out which document we should follow along with.
Okay.
So we'll follow along with Leah's amendment, and then you tell us the differences?
Yes.
Okay.
And if I might, Chair Neal, I'd like to have people from Department of Health and Human Services, DWSS, to come and explain the federal program that we use in Nevada so that the committee has some type of background information on this. So with your permission, you can ask them up.
Thank you very much. For the record, I am Cynthia Magaña, and I am with the Division of Welfare and Supportive Services, and I am here with my colleague, Brian Cullen, representing the Division of Welfare and Supportive Services Child Care and Development Program. Excuse me.
Madam Chair, my name is Brian Cullen, BrianCullen, and I'm here to represent the Child Care and Development Program with DHHS Division of Health and Human Services, Child Care and Development. Thank you.
Okay. Go ahead.
Thank you so much, Madam Chair. Cynthia Magaña for the record again. So we administer the Child Care and Development Program within the Division of Welfare and Supportive Services, and what we do is administer a program for families who are eligible based on income and household sizing. This program is to subsidize the cost of child care for the state of Nevada and assist families in covering that cost. We are held and bound by the federal regulations in order to administer the program. While there is some discretion within the program itself, the state has chosen to administer the program in its best of its capability to assist families in the state of Nevada. One of the things that the child care program does is offer subsidy assistance anywhere ranging from 0% subsidy copayment to 100% subsidy copayment, and a lot of nuances within that determining eligibility for the program. Thank you.
Okay. Do you want us to ask questions about that, or?
Yeah, if you can ask any technical questions, they're the experts.
So you guys are going to stay at the table, right? So let's go through can we go through the amendment, and then we'll ask questions on the program?
Cynthia Magaña for the record. Yes, ma'am.
Okay.
Yes, Chair.
So going through Ms. Case's amendment and then discussing the differences, and that's where we'll follow along. Okay.
So I'm sorry, Senator Spearman representing Senate District 1. And let me just give a little bit of background, and I think that everyone on the committee understands the challenges that families have faced with childcare. One of the things that became very irritating to me during COVID and then immediately after COVID, and still in some instances now, when people say, well, it's hard for me to find employees because they just want to sit home and collect the money. They don't want to go back to work, and that's not true. The people who need to go back to work are between a rock and a hard spot. They either have to choose to go to work or to go to jail because they don't have anybody to care for their children. And so that's why I bought this bill. I bought this bill because I wanted to make sure that people who are 80% of the state's median household income, and those are people who I know there are a lot of them in my district, make sure that they have adequate opportunities for child care. The federal government has already given 2 states, and Nevada has used the money to create the program that we talked about earlier. And so it's important to me to make sure that we use this and make sure everybody knows about it so that those people who want to go to work and cannot because they don't have affordable child care can do so. Shall I start? Okay. So in Ms. Case's amendment, the intent is to revise Section 1 and 3 of the bill to allow employers to apply for the tax credit if they assist any employee in paying for child care regardless of income level. The state has said that they in order to use this program, there is an income requirement.
Cynthia Magaña for the record. That is correct.
And that's 80% of the median income. They want to remove the requirement to verify eligibility with Department of Welfare and Social Services before applying to the Department of Taxation for the credit. And I believe in conversation with the administrator, they, according to the federal rules, they will have to do that.
Cynthia Magana for the record, and that is correct.
Sections 1(3) sub A and 3(3) sub A are updated to reflect that assistance may be provided for a child up to age 19 if the child has special needs. And I didn't get any clarification on that in terms of if that is actually allowed or not allowed.
Cynthia Magana for the record, according to the stipulations and policy regarding the child care subsidy program, that is a correct statement. We will allow child care for up to the age of 19 should the child have mental and physical disabilities.
Section 1(3) sub B and 3(3) sub B include providers of child care who are eligible to participate in the child care subsidy program, but may not at this time. These providers should be included as participants to maximize the number of providers participating and thus the number of child care spots available.
Cynthia Magana for the record, and that is correct.
I will jump down here to remove section 6(2)C to relate it to the number of children in a home not licensed as a child care facility. No changes are needed in NRS 432A at this time, and section 6 can be removed from the bill. So section, excuse me, section 6 starts off with, well, and it's up to child care facility does not include the home of a natural parent or guardian. Foster home is defined in NRS 424, a home in which the only children received, cared for, or maintained are related within the third degree of consanguinity or affinity by blood, adoption, or marriage to the person operating the facility. A home which a person provides care for the children of a friend or neighbor of not more than 4 weeks if the person excuse me, who provides the care does not regularly engage. 6 or fewer children of a neighbor or of a friend or a neighbor or any combination thereof. So one of the things, I'm sorry. Yeah, one of the things that concerned me when I looked at what is currently required, and that is sometimes there are people in the neighborhood who keep children and they are licensed, but they do this in their home. And it's a lot easier for the family to get them to that place than it is for them to, especially if they have transportation challenges. So I wanted to make sure that we included those instances, those challenges in this legislation.
Cynthia Magana for the record, and that is a correct statement.
I think what's throwing me off is that she says something and then you say that is correct. And I maybe it's because it's been a long week, but
So I'm just trying to make sure.
Okay.
I'm just trying to make sure that the amendment as proposed meets the same criteria that is recommended or that is regulated by DWSS.
I feel like I'm in an SNL skit. I swear to God. I don't know how to, I hate to say that, but I do. Okay, continue.
Madam Chair, would you like for me to further explain or elaborate on any comment or any statement that she has made so far?
I literally am going to wait and ask questions
Okay.
after this whole thing is over because
Madam
I'm
Chair.
afraid that if I ask questions and then we're not done, okay, we're going to hold questions till this presentation is over.
Thank you, Madam Chair.
Excuse me, access, the justification for removing that section is high-quality childcare is an important component to the workforce and economic development. But if I'm not mistaken, the actual program that DWSS does is there is a requirement to have that stipulation there. Did I read it right? Did I read it right? So So DWSS requires that DWSS requires that the participants are applying to childcare facilities that meet a particular requirement, a quality requirement. You can explain that, so.
Cynthia Magaña, for the record, yes, families do have the choice to participate or take their children to quality centers who do participate in the state's quality rating and improvement system, which is the QRIS. The family does have the option to send children to those centers. Now, all centers are participating in QRIS, but if they are participating, there is a quality measure that ranges from 1 star to 5 stars.
And that would be very similar to what you see in the Better Business Bureau. So families that participate in that quality rating they're able to look and see what child care facilities are actually meeting certain standards. And I think that that's important because we've heard some real horror stories about some places that do not provide the same type of quality. So. So I'm going to jump down here to the insertion of the amendment that was given by Ms. Case. Except as otherwise provided in subsection 2, the taxpayer who is required to pay the excise tax pursuant to NRS 363A may receive a credit against the tax otherwise due based on the amount paid by the employer. And no amount paid by the employer for the cost of child care pursuant to subsection 1 may qualify for the tax. May qualify for the tax for the credit authorized by the subsection of the amount paid. So now I'm confused. There's one stipulation here that I know that stands out. Like I said, for the most part, we're in agreement, but there are just a couple of places where we have to, and I believe DWSS has to receive the application. They qualify them, and DWSS is the one that actually provides the certificate. Did I get that right?
Cynthia Magaña, for the record, families can apply through the DWSS app, and we have child care resource and referral agencies that actually determine eligibility and then would hand out certificates to families who are eligible.
Okay, so here's what I'm going to do. We're going to start asking you questions because I think that's going to help clear up a lot. So I don't want to go first, but does anyone else? Senator Buck?
Thank you, Chair Neal. I know that increasing preschool, access to preschool has been an important step in helping children, helping to educate children, as well as improving Nevada's rating in education. And so are there any guidelines, specific guidelines in these home settings?
Cynthia Magaña, for the record, yes, even our registered and non-registered providers must follow quality health and safety guidelines.
Follow-up?
So is there any curriculum or expectation for learning at all?
Yes, for licensed providers, there is an age-appropriately and developmentally appropriate curriculum established that they must follow, and that is also rated through our QRIS system and verified, as well as with our licensing department.
And then are they monitored and site visits, or how does that work in making sure that people are doing the curriculum with the children?
Facilities are assessed through a coach, and once a coach is present on site at the facility, they do take a look and review the criteria that are used to teach the children and educate the children that is appropriately and developmentally appropriate. and they will review that. They are also re-reviewed at certain intervals, and I apologize, I do not know the actual intervals, but I can get you that information.
I think Mr. Cullen is going to elaborate.
Madam Chair, Brian Cullen, DWSS for the record. Just to clarify a couple things, in relation to what's being asked, we do have the subsidy program itself is what we do run by funding given to us by the federal government under the Child Care Development Block Grant Act. However, if the tax credit does go through, that would be a separate program, not the subsidy program. So we would be talking about two different things in that situation. Also, and if that was the case, the employees themselves would not need to be eligible for the subsidy program. They would just need to be receiving childcare somehow to get that credit. So they would be two different things. Thus, if you guys have seen the fiscal note, why there was an additional position requested, because it'd be a different program, it'd be something else that needed to be evolved with the way this transitions. And I just want to clarify too, the state of Nevada, we did increase our income ceilings to the maximum of the 85th percentile this past July. So I just want to clarify it's 85%, not 80%. It's written on the paper documentation. So just wanted to clarify those things before we get going down the road.
And if I might address the fiscal note, I did ask Mr. Thompson, is this, the fiscal note, the $200,000, is this something that could be absorbed by federal funds? And he said yes.
Senator Buck, you're up. Okay. Senator Gansert.
Thank you, Madam Chair. So kind of just to go back over this again, if you have a company that is willing to contribute money to this plan for childcare, then the employees of that business do not have to fall within the income threshold. They are eligible for a tax or for the subsidy, and it looked like maybe up to $5,000 a year. Is that correct? I guess I'm referencing the amendment. I mean, I think you just said that, and I was looking through here. So if a company participates in the program, their employees do not have to meet the income threshold to be eligible?
Yeah, Senator Spearman, for the record, and I believe that that is correct. And I think that's part of what Ms. Case was saying in terms of eliminating the income level.
Okay, and then if
or qualifying for the other program.
Thank you. And if there's someone who is trying to qualify for the program, normally it's an 85% of, is it the median income for the state or for counties, each county, or?
For the state. For the state.
For the state. And then going back to the small facilities, like the in-home facilities, are still licensed and monitored. And in the past, it sounds like they have not been eligible to participate in the subsidy programs, but now they would be allowed to participate in the subsidy programs?
Yes, I'm sorry, Senator Spearman, for the record. Did get that right?
Cynthia Magana, for the record, allow me to clarify. Yes, there are some in-home centers that are licensed, and we also have unlicensed centers that are unregulated, but they would still provide care.
So just to follow up on that one, so licensed and unlicensed are eligible to participate in the program?
Yes, and that's because, remember when I said there's some places where a friend, a grandparent or somebody, they're keeping them because it's a lot easier for them in terms of transportation. So it's to make sure that we don't cut anybody out if they can't get across town.
So I think like your neighborhood, that makes some sense. But what's the licensing process? Is that a difficult process? Are there different standards? I guess there's standards that the unlicensed do not have to meet versus licensed would have to meet.
Senator Spearman, for the record, so it is my understanding that the unlicensed ones would still be regulated to a certain degree. They still have to make sure that they met certain standards. Did I get that right?
Cynthia Magana, for the record, we refer to these providers as friend, family, neighbor providers, FFNs, and they have always been allowed. But yes, there is also a certain standard that they have to meet, but not a licensing standard.
Okay, thank you.
Thank you.
And Senator Spearman, for the record, and that's mainly because when you look at that type of setting, there are people who already know each other. I know that there's some people in my neighborhood that keep family members' children after school, and because the family lives maybe 4 blocks away, but it's convenient for the kids to get off the bus and go there.
Sure. I think childcare is a huge issue, and having people who you trust help you with your children makes sense. I didn't realize that there was potentially an exchange of funds, right? So they can be paid for those services if they're licensed or unlicensed, as long as they're recognized by DWSS maybe, and they're following certain levels or certain standards.
Cynthia Magana for the record. FFM providers are regulated by the Division of Welfare and Supportive Services.
Okay, thank you. So just they're regulated but not necessarily licensed.
Cynthia Magana for the record. That is correct.
Thank you.
Senator Dunyate.
Thank you so much, Chair Neal. I'm still a little bit confused, but I'm going to try to phrase my question in a way that could help me get there. It's just I'm trying to go back and forth as to what the amendment does and how the bill's structured and the requirements, et cetera. So, personal anecdote, because I think I understand what you're saying. So, there's actually a company in my district that I have encountered with, and they're doing really good work. They're Tacotarian, who has established different facilities throughout. They're a restaurant chain, and they've established different facilities throughout town and have continuously expanded. And one of the main issues that their owner has mentioned to me is childcare, right? That is always the issue with their employees having to show up on time. Child gets sick, they can't show up, creates a whole process, right? And so what they have started is they have decided that they wanted to rent the space upstairs for childcare facilities, and they would rotate their employees to take care of everyone else's children based on whoever has current status of employment. I think this is just a question. Wouldn't it be just cleaner just to say if a company finds themselves in that instance where they want to provide the childcare services for their own employees, but it would benefit to have some sort of incentive, couldn't it just be as simple as if you find yourself in this capacity and you're like a small or medium-sized business and you wanted to apply for it, you could receive this tax credit and this is how much you can apply for it? Wouldn't that be it'd be a straight shot, it'd be easier, that way you don't have to go through the different regulations? Because at the end of the day, it's the company doing it themselves. It's a little bit cleaner. Is that something that is worth an appetite, or what's your perspective?
So they still have to meet certain standards, health and safety standards, and
Cynthia Magana for the record. Yes, if they're going to be taking care of children 6 or more, it is a requirement by licensing in the NRS that the facility must be licensed. So they would have to meet certain health safety standards and licensing requirements.
but I also don't think that the licensing standards, health and safety, I don't think that they are so onerous that they wouldn't be able to pass the test. But they would have to meet those standards. I mean, he just couldn't say, well, we're going to go up here and, you got mold in there. And this is probably an obtuse one, but if there's mold there, or if there are certain things that are not sanitary or whatever, they wouldn't be able to do that in that instance. If it's someplace where he has converted to be a child care facility and it meets those standards, then I don't see any reason why he wouldn't be able to be a part of this. Does that make sense to you?
Okay. So I'm kind of going to work backwards on my questions. So for FFNs, because the way the language reads, any taxpayer who is required to pay the tax may receive the credit against the MBT. So if you're an FFN and a business, I guess, creates an agreement with an FFN to pay for someone's child or children to be taken care of, walk me through the process.
Are you in Section 1?
Well, Section 1 lays out the requirements, like any tax, who is eligible to participate.
Mm-hmm.
But tagging on to the FFN question, I just want to know how that would work. That you have a neighborhood provider because not everybody is trying to go to, a facility. They have a neighborhood provider. They find that their employer is willing to pay. Because what I read, there can be a direct payment as well. Talk to me about the credits working with the FFN on the MBT. So I'm trying to figure out who's, like, if it's an FFN who takes advantage of this program because they're keeping people's children.
Yeah, if I can just ask you the section, because I can go there and.
It's not in the section, because I don't know if it's even in the amendment, but you guys were talking about the family friend that I'm assuming FFNs are included in this.
Cynthia Magana for the record. Yes, they're included in this friend, family, neighbors, FFNs. We can enroll the provider under the employee-funded program.
Okay. And then, and I don't even know, should I ask questions on the amendment?
You can, but we're still kind of working through it because I want to make sure that every voice is heard, but I also want to make sure that, and that's why I brought in DWSS, because I need to make sure that all the tenants that are in both amendments will not cancel out the opportunity for people who want to participate. That makes sense to you?
Yeah, it does. So the eligibility that's struck out in the amendment to be determined eligible by the Division of Program and Child Care Development as defined in NRS 422A.055, is that staying?
So DWS, if I'm not mistaken, DWSS has to qualify, and what the amendment here says is that.
Well, it strikes it out.
It strikes it out. So we can't strike that out.
Correct.
Yeah.
I'm sorry. I feel like I just replaced you. Okay. Because I was just like, that can't leave. All right.
Madam Chair, if I could say this, and I know that it's probably a little confusing, and what we started out with was trying to, I had a bill in 2015 that was very similar to this, but we couldn't figure out how to fund it. And so working with Division of Welfare and Support Services would give us the opportunity because of money that is coming to us from the federal government. And so we're trying to reconcile because, what Ms. Case has, they're very valid points, but I also want to make sure that we're not doing something in the bill that would cancel the funding. Because if it cancels the funding, then that basically eliminates the bill, that eliminates the intent. And so we're still trying to do some crosswalking.
Okay. So then Senator Ganser, because I'm going to ask anyway.
Thank you, Madam Chair. And so, I was just thinking about the situation where you have an employer who is utilizing the tax credit, and with that, then they don't have to, their employees don't have to follow the income threshold. So what if you had a large company that could put $2 million, wanted to start a child care center, like on-site child care center. They literally could put $2 million or into the tax credit or get the tax credit for $2 million and then start their own child care facility. Because I think you're trying to get out small entities too, and I didn't see a cap on how much any one entity could contribute. Because again, say that you had a large business. I don't want to call out any certain businesses, but you could be a gaming company, you could be a hospital, you could be all sorts of different companies that pay the tax, right? And you can get a tax credit basically to provide those funds for the care. So you aren't necessarily going to be able to have a distributed model if you have large companies taking advantage of this without any income thresholds for their employees.
Yeah, I didn't see any caps when I looked at the bill, nor did I see any caps when I looked at the federal program or the state program that we're running. So I could be mistaken, but I didn't see any.
Brian Cullen, Division of Welfare, for the record. Just to clarify on that with the regards to the block grant money that we do receive, and again, it's a separate program. So without any additional monies, Child Care and Development Program can validate the providers for employers if they had gone elsewhere, and that's how that would come out in relation to working stuff. But as far as the taxes itself and the program itself, would be a totally different program, which we do, would be able to assist in providing that information for.
So I'm going to say this, right? I'm going to take chair privilege right now. You got to get rid of that amendment. The amendment is not functioning, and it's not helping to understand this hearing in particular. So I understand the removal of the threshold, because one of the things that I said before you presented this bill was there are middle-income families who need child care assistance. And if you're going to create a bill that allows middle-income families to benefit from this bill versus the under 80% threshold, which is still fairly poor, then to me, the way to do that is just to, in section 1(3)(a), which would be to raise the income threshold, right? So that it would meet middle-income families who typically are struggling, who may have an employer that would allow them, who they need an employer to help cover the cost of their child care, who would say, you know what, I want to take advantage of this MBT reduction so that I can help you get child care so you can come to work. The amendment strikes out things such as, providing payment to the Department of Taxation within 30 days after the receipt, different things that I think are needed for the administration of the program. And I believe those things cannot be removed because you are bringing the MBT into the tax credit plan for childcare. So my suggestion to you is take your original version of the bill, make the changes that you want to make and keep it minimal, and disregard the amendment, because the amendment is not, it's confusing. I think it messed up your presentation because I didn't know what the second amendment was, number one. And I think ultimately what you're trying to get at and get to can be accomplished through the original version of the bill with some small minor changes. So that's the route that I think you should go. I don't want to really ask any more questions because I really don't want a repeat of a bad hearing, right? I've already had one for this session, and I'm good. I don't need to. So we're just going to open up for support. That's what we're going to do. All right.
That's fair. And like I said, this, because we're trying to get the money and no fiscal note, and trying to make sure that the people who are stakeholders in here, child advocacy, to make sure that their concerns and suggestions are taken into consideration, but also have to make sure those things comport with what the program that we already have that gives us the money, if that makes sense to you. So
I think we definitely understand the concept. I just think there's a simpler way to get to where you're going. Put in who you want to be the qualified entities to receive it, and then make sure that that's super clear, right? On which businesses can actually receive the credit, how it will be applied, who will administer it, and then you go from there. I don't think it has to be super complicated. So we'll just go ahead and open up for support for SB 278. And no offense to anyone who wrote the amendment. All right, is there anyone in support of SB 278? If you please come to the table. Okay, is there anyone on the phone line BPS in support of SB 278?
Chair, there are no callers in support at this time.
Okay, is there anyone in opposition to SB 278?
Good afternoon, Madam Chair and members of the committee. Leah Case, on behalf of Children's Advocacy Alliance. I had signed in support. I'm afraid there must have been a miscommunication, and I thought we were coming in support of this. So I apologize for the change in sign-in. As to the amendment, as you heard from the bill presentation, we appreciate Senator Spearman and her bill and reaching out to us to try and come to some agreement on this. As you heard in the presentation, there is already a program, the Child Care Subsidy Program, that addresses families with the state median income up to 85%, so that their child care payments are at least partially made by the state program. What we were trying to get at in this amendment was to allow this tax credit program to get to more families, so create a different program that does not go through Division of Welfare and Supportive Services because they have staff that just manages the child care subsidy program. This would strictly be a tax credit program for other employers, you know, including those up to 85% of the state median income, but then anyone outside of that. You know, my income is above 85% of the state median income. I still struggle to pay for childcare. I have an employer benefit that allows me to pay for that childcare, and my employer could then benefit from this modified business tax write-off. But I do not qualify for the childcare subsidy program. So the goal and the intent of this amendment is to broaden those folks who can then make credits against their modified business tax. As far as Section 6 and the number of children allowed in a home before it becomes a child care facility, so Section 6, Sub 1, the Sub 1A includes the definition of a child care facility with 5 or more children. So if we have Section 6, Sub 2C includes 6 or fewer children, we then have a conflict there. There are already family, friend, and neighbor providers in the state who are regulated. They do have the health and safety inspections. They may not necessarily be licensed, but you know, they're the person down the street who's taking care of the kids. So at this time, we would not support that inclusion in Section 6.2C. And I am happy to try and answer any questions on this. Tax policy it's one of my favorite committees. It's not my expertise, but I am happy to answer questions. Thank you so much.
Members, do you have any questions? Nope. Okay, go ahead.
Thank you, Chair Neal, members of the committee. My name is Tom Clark. I'm here on behalf of the Children's Cabinet. We have worked very closely with Leah Case and her organization on this particular amendment, and I am not an expert on these issues at all, but I get to have the pleasure of working with a lot of experts in the child care world with the Children's Cabinet. So what we'd like to do is continue to work with Ms. Case, thank Ms. Senator Spearman for bringing this bill forward, and hopefully we can meet somewhere in the middle and find some resolution so that we can fill the gap for these families. Thank you.
Thank you for that. So BPS, is there anyone on the phone lines in opposition to SB 278?
Testify in opposition of SB 278, press star 9 to take your place in the queue now. Again, to testify in opposition of SB 278, press star 9 to take your place in the queue. Chair, there are no callers willing to testify in opposition.
Okay, thank you for that. So we will go to neutral. Is there anyone in Carson City in neutral to SB 278? Is there anyone on the phone lines in neutral for SB 278?
To testify neutral to SB 278, press star 9 to take your place in the queue. Chair, there are no callers willing to testify neutral.
Okay, so we will call the bill sponsor up for closing remarks.
Thank you, Madam Chair. And if it's confusing to you all, you know the maze that we've been trying to go through to make sure that this works. Unless I'm mistaken, the MBT is a tax that goes to the general fund, and any type of abatement would reduce that, which is why I was really trying to stay with what the state already does, because that way we can get it paid for. To eliminate the 85% and just go strictly with the MBT, I don't think that we could get it across the threshold. maybe there's another way. I don't know. But I want to make sure that even if we can just start with this, and perhaps next session come back with something else, maybe some things would have changed. But I'm acutely aware that anytime you mess with the MBT and it gets to the Money Committee, it's probably not going to go anywhere.
Thank you for that. I think there is a threshold. You just need to figure out what it is. I don't think it's no threshold, right? I don't think it can be everyone. So you need to figure out what's the income that you would like to cap it at and then bring that down.
Which is why we went with the program that the state offers. And theirs is 85%.
And below.
Yeah, and below. And so, again, I say that, the difficulty here is, would I like it to be open to everybody? Yes, I would. But anytime the MBT is involved, then that raises the possibility that it goes nowhere.
I understand. You guys can work it out, but clearly maybe it's, a different threshold, income threshold amount. Maybe it's 150%, but it's not no threshold. Because that could be a millionaire. That could be somebody that makes $400,000 who then is eligible for the program, right? That's unworkable.
Yeah.
So try to figure out who your grouping is and who needs it. Because there are some middle-income families who could benefit from that. Figure out what that income is. And then I think you'll be okay.
Yes, ma'am.
All right. So we will go ahead and close the hearing on SB 278, and then we will open up for public comment. Is there anyone here for public comment in Carson City? There's no one in Vegas. BPS, is there anyone on the line for public comment?
If you would like to provide public comment, press *9 to take your place in the queue. Chair, there are no callers wanting to provide public comment at this time.
Okay, so we will go ahead and adjourn Senate Committee on Revenue.